Hey guys, what's up? Hope you guys are having a great day today, and welcome back for another episode of the weekly market analysis. So yeah, I hope you guys are having a great week. We got about, let's see, 6 different currencies to go over today, and yeah, should be fun. So let's go ahead and get into it. The first currency pair that we're going to go over is the Euro New Zealand. So as you can see, the Euro New Zealand barely broke below the structure level and closed below the structure level, which led me to see this retracement as an opportunity to go ahead and get involved in what I would think would be a trend continuation pattern. I say think largely because I don't really know. No one has a crystal ball. Okay, so I'm not 100% sure what's ever happening in the market at any one given time. And I know that's not very popular. A lot of people want guarantees, particularly when it comes to investing and trading and risking your money in the markets. And the main reason for this is because most people are so risk averse to the point that they would never even want to pursue a venture like this. Most people they don't like the idea of risking their money on anything where there's a possibility of losing it. You know, it's kind of the whole human mentality that once we've achieved something in life, we hold on to it desperately to keep it. And when in reality, if we risked some things, I'm not saying you have to risk everything, but when you're willing to risk some things, you might find yourself gaining much more than what you have achieved in the first place. Anyways, that being said, though, what we do have here, however, is we do have a double bottom at the end of this move. As you can see here, let me zoom in for you. So we have a double bottom. The first test of this price level of 171.68 hit right here, and then it rallied and then came back down to create our double bottom. This lowest low here equaled the lowest close, and while we closed beyond the lowest close of the first test, we did not close below the lowest point on the first test. So that is the definition and that's the rules, at least from my perspective and my rules of what I need in order to see a valid double bottom. You may have another way of looking at double bottoms. You may say that the lowest low of the second retest does not have to equal the lowest close of the first test, and that the second retest can close below the lowest low of the first test. And, I know it's getting all kind of confusing and whatnot, but that said, as long as you've back tested it, I really don't care 100%, largely because you back tested it over historical data. You have the statistical evidence and data to say that there appears to be a positive expectancy here, and that so regardless of my opinions of what I define as a double bottom, just know that, that's mine. You don't have to agree with that, and I wouldn't be upset or argue with you over it, just so long as you've tested it. But for a double bottom, for me, you cannot close, but the second retest cannot close below the lowest low, or if this was a bearish double top, then the highest high. But it can't. The second retest can't close below the lowest low of the first test, and it has to equal the lowest low on the second retest has to equal the lowest close of the first test. Okay. Hope that wasn't too confusing. But anyways, this is a valid double bottom, which is a reversal pattern. Now, the key question here is whether or not this is going to be a retracement and it's going to continue in the direction of the bearish move that Euro New Zealand is already in, or whether this is actually going to be a full-on reversal that's going to come up here, violate this structure high at 76.55, come up here and violate this structure high at 79.81. If it does violate this structure high at 76.55, 53, or whatever I said, then I would estimate that it's probably going to try to come up further, and I would look for a potential 618 fib retracement from this structure high up here to this structure low down here. And then, of course, if that was to get violated, I would probably look from here. On top of that, this would probably be from this structure high swing high to swing low, to this structure low. If that was to happen, I'd have to do the calculations to determine if my trading strategy would even allow me to get involved. The risk may be too high in this case. And, you know, hey, I'm not saying that you shouldn't be unwilling to take risks that are too high. You just have to be willing to control your risk. I know I just gave a little speech there about people unwilling to take risks, and here I am saying the risk might be too high for me. Please understand that what I mean by that is that you need to control your risk. Most people are willing to take even the slightest amounts of risks, or at least what is perceived as a risk. I mean, getting in your car every day is quite risky. So the truth is that when it comes to, you know, risk aversion, it's really more about what the perceived risk is. You know, getting in your car isn't exactly perceived as a risky thing. That doesn't mean that it isn't. That said, though, when it comes to this, there's a lot of people who are highly risk averse to even the slightest amounts of risk when it comes to their money. So what I'm saying in this situation is just that it's not bad to not take trades because of risk. You don't want to take trades because of massive risk. You have to take risks in accordance with what your trading strategy and the probability of your backtesting has shown you for your strategy. My strategy has just shown me that over the backtesting that I've had, risking over $200 is quite risky and not a good idea, largely because in most of the currency pairs that my strategy has been shown to be profitable in, or at least has a positive expectancy, you know, they're only probably like 51, a little bit over 50% accurate in terms of how often it wins as opposed to how often it loses. So because of this, $200 or over $200 worth of risk is risking quite a lot. So in this, that's why I avoid it. So what I would do is I'd measure this, and I would actually have to calculate the risk and see what happens, you know, see what I get from that. And if it's too high, then I wouldn't take it. Another thing is I may choose to not take it, because if I see that the market has closed above here, then I might wait for the market to start trending in this direction, you know, to start trending bullishly. And if it does start trending up, I may actually start taking those trades instead of this trade. And that's the difficulty with this trading strategy. When do you decide to flip your analysis and go in the different direction, right? I've talked about this in other videos before, but when do you decide to flip your analysis and go in the opposite direction? Like right here, let me see if I can find an example real quick. I know I'm kind of belaboring this point here. So, okay, so right here, you know, we've been bullish since December of 2019. Well, actually, we were kind of consolidating. We made a new initial high. We had our initial low, initial high. We had our retracement, and then we had a new higher high, higher close right here. And then we retraced, and we retraced again. We had a two drives, complex pullback, okay? This may have even been a harmonic move if this leg of the move is the same length of this leg of the move, but we'll get into that in another thing, at another time. And actually, I did a video about ABCD patterns and recognizing them in another video, so if you're interested in that, go check that out. I'll go ahead and put that in this video, so you'll see an eye in the top right corner of the screen, and go ahead and check that tag out. I think they're card. It's called a card. So check that out if you're interested and you want to see ABC patterns and whatnot, or at least that video. That said, though, you know, in this case, we clearly had, you know, a breakout of here, but we hadn't really violated this structure level or any of the structure levels back here yet. So then we come down here. So you probably would be, you know, for me, I would have taken a 618 fib retracement trade right here, a trend continuation, hoping that the market would have moved down. Clearly, I would have gotten stopped out around here. And now we've created a new higher high, higher close. So what do? Do you look further back and you say, okay, well, you know, I'm going to look and I'm going to do this. I'm going to take this fib retracement tool and I'm going to measure from this structure high to this structure low or whatever. And, oh, well, I got a 618 fib retracement, or maybe I'll measure from this, it's a bit more significant, or maybe I'll measure from this, it's a bit more significant. If you measured all the way back here, you never would have got it based off of this particular structure high. But, like, do you continue to do that all the way until you definitely get to the most major resistance level that you and then the market violates? Or do you finally say, you know what? We broke out. We've had a pretty big breakout. Is this just a big complex move? I mean, down here, it looks as though you've got a double bottom. Let's zoom in here just to see. So yeah, you've got a double bottom right here. This was the initial double. Actually, you have what's classified as a triple bottom. Okay, this is a triple bottom. It's a very good example of one. We have the initial test. We retrace. We get the lowest low of the second retest equals the lowest close of the first test, and then we retrace again a little higher. We do break above here, and then we retest the same support line, and the third lowest low equals the lowest close on the first retest. So the third retest equals the first retest. Okay, so that is a validation, and in fact, we may have had a quadruple bottom, or a quadruple bottom where we had a 4 retest. We had a retest of, you know, this price level 4 times, because if as you can see right where it closed, this actually came down and equaled the close as well. So anyways, that said though, obviously the market was finding support, and that was a reversal sign. We were in a bearish trend, very clearly in a bearish trend. You can't really deny that, because we were moving from the top left corner of the screen to the bottom right. We were definitely in a bearish trend. So at least from this point to this point, I'm not going to go zoom back and see what's back there, but you know, now, so we do this, we kind of consolidate side, we're going a little higher, and then we finally break out. At this point in time, do you take the trade here? Do you keep moving your fib retracement tool further and further and further back, like so? Do you keep measuring further and further back? Like this, measure from here. Nope, that didn't work out. Okay, next one, that's kind of minor. I'm going to measure from here. This is a bit, in my subjective eyes, I see this as being more significant of a structure level. You know, do I measure there? Okay, clearly no, we got stopped out here and then here. And then do you do that on and on and on? Or do you see, or do you flip your expectations and you measure from this structure low to this structure high, swing low to swing high? We get a 618 fib retracement, and we rallied, and we would have made money. It's very, very difficult to make that kind of decision when you're in the moment. It's easy to make the decision now because we can clearly see that the market rallied. But it's hard to make that decision in the moment, right? It's really hard to do that. So in this case, what should we have done? Well, we should have flipped our analysis. Usually what I try to do, there's 2 ways that I like to handle. The first way is I will take one trade, measuring the fib retracement tool from, you know, swing low to swing high, or from swing high to swing low, structure high to structure low. And then I would go ahead, and if I got stopped out, then I might consider taking another trade from another structure point. And then if I lose twice, I call it good. The other way that I like to handle this is sometimes I like to go, okay, if I lose the first time, I'll flip my analysis and go in the opposite direction. But when you have something like a complex pullback, so like in this situation right here, clearly, you know, we have a complex pullback right here, extension, retracement, extension, and then we have a complex pullback right here, extension, retracement, extension, right? Now, if we weren't looking at the bigger picture and trying to take the bigger trade from this structure high here to this structure low, we would have had a 618 fib retracement. We would have been shorting the market. You know, what we could have done is we could have looked at the more minor structures. So you see, we had a initial low, initial high, a retracement, and then a new structure high, higher close. And then we retraced. I could have done a fib retracement tool from this structure low to this structure high, swing low to swing high, right? I could use my fib retracement tool. Could have taken a long trade right here in hopes that it would have rallied. In this case, what happened? We would have gotten stopped out because we had another 2 drives complex pullback right here, and we in the opposite direction, as a bearish move. And then, so I would have been like, okay, and let's assume you can't see any of this, right? So this is what happened. So we got stopped out here. Okay, well, I got stopped out here. I don't know that it's going to rally like it did. So I'm going to say I'm going to go ahead and flip my analysis. Let's go ahead and flip and draw my fib retracement from the structure high to the structure low. And then I'm going to go ahead and get short again right here, because we violated the structure level here, and we've been in a bearish trend for quite some time. So it's not out of the realm of possibility to think that this is just going to continue its bearish trend. So you're taking a second trade here. So this is what you do. You know, you go ahead, you get short, put your stop loss 10 pips above the high, or however you want to place your stop losses, and we get stopped out. So you can get caught in the whipsaw of consolidation. You get caught in the whipsaw that way. That is absolutely possible. It happens all the time. But it's very difficult to make that kind of decision of what to do. So if we were to break out here, okay, obviously we're coming down. If we were to find support, which there are structure points, if you look left, structure leaves clues, there are support levels. Now that we've broken up, once we violated a resistance level, resistance turns to support. So we could find a support level here. I mean, we've had 1, 2, 3 times that this has been hit. If we look even further back, I'm sure there probably is more. But at least in the immediate vicinity, we've had at least 3, times where the market respected this price level, and it has acted as support. That being said, though, I think that if this were to rally, I might consider in looking for a reversal in the pattern. I don't know. We're just going to have to see. We're going to have to see what structure is telling us. We're going to have to see what price action is telling us. We're going to have to see a lot of things. But anyways, this is how I got involved. We broke below, closed below, and then we rallied, give me a 618 fib retracement. This could seriously find support and then rally. That's always a possibility. And also I measured from a minor structure level here instead of the more major structure level up here. That could also play against me as well. However, I would say that if it breaks a structure level here and violates that level, I'm pretty sure it's going to violate this because they're so close together. But and then I guess at that point I would probably look to take a trade and reverse my expectations, reverse where I think the market's going to go. But that said, let's go ahead and move on to the Pound Aussie. This is the Pound Aussie trade. I don't really know what to think about this trade personally because it already has closed beyond my entry level here. And I went ahead, I don't even know, looking back on it, I look back on this trade and I'm like, you know what? I don't see this trading opportunity that I'm attempting to take here. I just don't see it. What I see is that I should have measured my fib retracement tool from this structure high to this structure low, swing high to swing low, and I should have waited for this, which we clearly never got. So if I end up making money, then I might look to this and I might look to short. But at that point, I don't know. I don't really see the trade that I ended up taking here. I see this more so than anything else. I also see that I could have measured from here, here, here. These are all minor structure levels, but I could have measured from them. I could have measured here. Okay, I could have gotten involved. I could have shorted the market, and I'd be making money at this point. So I don't know why I decided to take this trade as opposed to that. Not really sure. I know I probably took this trade back here earlier where I probably drew my fib retracement level tool from structure high to structure low right here, and we clearly got stopped out. So again, this is another situation of, do you flip your expectation or do you take a second trade in the same direction? Clearly for me, I flipped my expectation the minute I'm pretty sure I took that trade. You know what? Did I take that trade? Give me a minute. Let me find out. All right, yeah, looking back on the Trading View Trade Analysis Journal, as it turns out, I did take this trade right here, and I ended up losing about $111 on the trade. So because of that, you would think, well, I mean, hypothetical money. But because of this, I flipped my analysis to go higher. If this was a full-on reversal, which we do not have a reversal pattern, we do not have any kind of a valid double bottom, triple bottom, or otherwise. So, doesn't look like, and I'm not really seeing the signs of a reversal here. So I'm really thinking I should have taken a second crack at this instead of, not. I mean, just because we have a double bottom doesn't necessarily mean that it's going to be reversal. I mean, here's an example right here. This was clearly a double bottom. The the lowest close, or the lowest low of the second retest equals the lowest close of the first retest, but it does not close beyond the lowest low of the first test. And so it's a valid double bottom. Actually, it's a valid triple bottom. 1, 2, 3. And then we rallied all the way up here, and then we just continued. So just because you have a double bottom does not mean the market's going to reverse every single time. Just keep that in mind. It doesn't always mean. Sometimes you can very easily have this kind of a, structure where we just come down and we rally and that's it. And we don't have a double bottom. We don't have anything of the sort. And we just kind of rally higher. So, I mean, that can easily happen too. So there's no guarantees when it comes to trading. Just keep that in your head. No guarantees when it comes to trading. But that said, though, I decided to flip my analysis instead of deciding to take a whack at this at one of the higher structure levels and kind of go from there. I kind of think that with what the market's already showing me, it's going to continue to fall and I'm going to get stopped out. So I'm not happy I took that trade. I don't know what I was thinking when I did. But I don't feel very confident about this one, just judging by what I'm seeing on the structure. I don't feel confident. We also were overbought. We have an overbought condition on the RSI here at 89. If you look back, the bottom left corner here for the number, we have 89.3, or actually, where is that 89? Well above the 80s, 89.13 right there. So, and we had this here, so we were overbought all the way here. We continued higher even more. I don't know if we had another overbought condition after that. I don't think we did. We did not. And then we did have an oversold condition right here at 1441. And then we continued to fall. Again, this is one of the reasons I don't use the relative strength index, because it's not always accurate. Sure, it can be kind of accurate, right? I mean, absolutely it can be. Right here, we had an oversold condition, 1724 right here. We came down here. It was a small oversold condition, but oversold nonetheless. And then we rallied right here. And then we didn't really have an overbought condition that I can see here. Nowhere around here do we have an overbought. And then we fell, giving us another oversold condition at 1673 right around here. Fell again, and then finally rallied. So it can be helpful, okay? I mean, we had an overbought condition here at this given point in time right here. Came down, had, I believe, probably another overbought condition right up here. And then, as you can see, we reversed. So I'm not saying the RSI is not a good indicator. I'm not saying that you can't use it in your trading. I'm just saying that I don't use it in mine because I haven't found it to be the most accurate when it comes to identifying. Well, it has its statistical probabilities associated to it, just like everything else. I just don't like, using indicators in that way. I like to go purely based off price action, and I like to wait and actually see where the market is going. The market break structure, this indicates one thing type of thing. I like to do that. The only thing that you could say that I use could be classified as an indicator would be the Fibonacci measurement tools. That said, that's the pound Aussie. Let's go down to the pound Swiss. That's the next trade we got going on. Oh, and it's already, wow, I didn't think that was going to happen at all. Well, okay, so when I came into this trade, again, we had another situation here. And let me see on here. We're on the pound Swiss. So let me see if I had another trade here. Took the 7-1. Yeah, okay. So I originally took this trade over here. And I measured from the structure high to the structure low. I got my fib retracement level, 6-1 fib retracement level, and we ended up, and I shorted the market, but then we ended up getting stopped out. In this case, this actually worked in my favor. I saw that we came down, we retraced, and then we extended again, and we ended up breaking above and closing above the structure level. So I thought that if we came down here, I'm going to flip my analysis and turn bullish instead of holding on to what I was previously talking about and try and take a bearish trade from the structure high to the structure low. And the main reason I did this, I could have shorted the market right here. This could still happen, right? This could still, if I had entered here, my stop loss would have been up here, so we clearly would not have been stopped out at this point. But yeah, I don't know. I mean, I just, what I saw is that this is if it already broke above, there's a good chance it's going to continue higher. So I decided to reverse my trading expectations, if you will, my view on the markets. That said, it ended up working out for me. I'm not going to... So, I mean, if you look at this really, I mean, I got involved in the trade here. We continued lower. We continued lower. I mean, we got within a few pips of my stop loss. I thought for sure when I saw this trade, I was like, man, why did I take that? You know, it's a bad idea. You know, I'm going to get stopped out. Look how low it's gone. But I was proven wrong. It ended up rallying. Just goes to show you, you never really know. The market clearly wanted to be bearish, and then it decided to change its mind. It went bullish. Who knows? I mean, look, I mean, honestly, there's a ton of fundamental news that's out there that could probably explain, or you could justify this kind of move with that. But I'm going to be completely honest with you. Trying to determine market movements based off fundamental analysis is very, very difficult. Which is why I don't like it. You know, trying to determine what a piece of news. Let's look at these news items. We had, well, actually, none of these news items have actually come to fruition yet. But you car registration, average earnings. This is all for the UK, I believe. Is it for UK? You know, I believe that the yellow is the UK, and then the red is the Switzerland news. But then, you know, I'm not really sure because clearly we have the Swiss symbol right here, and that's yellow. And then we have the pound, the British symbol right here, and that's yellow. So I don't really know what the difference between the colors are, the difference in coloration. I'm not really sure. But, well, as you can see, just by the fact that the actuals haven't been filled out and the date and the time, they haven't really come to fruition, or at least that they haven't come out with the numbers. At least TradingView doesn't have the numbers. It's a possibility that the numbers already came out, and that there are services out there that you can pay to get news information much sooner than everybody else. They're very expensive, and you can make trading decisions. That very well may have been what happened. Okay, large institutions such as banks, trading institutions, what have you, they very well may have services. They probably have services that show them all of this economic market data that can show them what exactly is going on in the market much sooner than everybody else, and now they're reacting to this stuff, and yet we don't have the data yet. Now, this data could be posted somewhere else, and TradingView just hasn't updated. I don't know. Okay, I really don't know. But I'm just trying to tell you, that's why I don't like fundamental analysis. That not only that, but you never really know how the market's going to react to news items. You can see that, or you could say that earnings reports, I mean, you see this on the stock market all the time. If you're in the US, you know what I'm talking about. On the stock market, you know, you can have a positive earnings report, and it could tank the stock. And then you have a negative earnings report, and the stock is totally unfazed, and it was already going up, and it could just continue to go higher. You never really know how the market's going to react, which is why I like to go with structure. But still, you don't know 100%. You never know. But I feel like structure analysis is easier, in my opinion. It takes a lot less work, in my opinion, than all the research that's required for fundamental analysis. But this ended up, you know, working out, and that's positive. I'm really happy about that. I didn't think it was going to work out at all. Let's move on to pound yen. All right, pound yen, as you can see here, you know, I could have taken a trade from this structure high to the structure low. I mean, I clearly could have done that, but instead, I decided to focus on the more immediate structure instead of a bigger picture type of trade. And I saw that we had the initial low here, initial high, retracement, new higher close, retracement, new higher close. So I decided to go ahead and draw my fib retracement tool from this structure low to this structure high, you know, swing low to swing high. And I got my 618 fib retracement price level right here. That's where I entered the market. Place my pips my stop loss 10 pips below the low, and my target is at the highest close, or the highest body of the candlestick, up here. And that is that's what I decided to do. That said, though, I wasn't feeling very strongly about this yesterday, because when I saw this yesterday, it was probably around 8 a.m. in the morning, maybe 9 a.m. in the morning that I saw this, and we were already past my entry point. I still don't feel very strongly about this. What I see here is that I could probably short the market Measure from this structure high. Oh, I didn't actually click on it. Measure from this structure high to this structure low down here. I would have gotten involved and I would have shorted the market down here. This is something that I kind of see that I could have done. I also see that I could have drawn my fib retracement tool from this structure high to this structure low and it shorted the market. Again, at a very similar point, entry point right here. But as you can see, we're constantly going higher and higher, so I would have been pretty close and getting worried about getting stopped out. That said, though, I just decided to go ahead and shoot for a bullish trade here instead of, and in hopes that this is going to continue to reverse from this bearish trend we've been on. But in reality, I don't know. I really don't know. I see that we're making lower highs and lower lows. So that's typically an indication that we're going to continue to head lower, and that very well may happen. So we'll just have to, but just like the pound Swiss has shown us, we don't really know. So we're just going to have to wait and see. This trade, oh, look at that. We're getting higher. Look at that. Not bad at all. This trade was another one that I wasn't 100% sure about because, you know, as you can see, initial low, initial high, retracement, new higher, high, higher close. We look as though we may have had a double bottom. We did have a double bottom, a valid double bottom here. But we also have a triple top. Look at that. It's pretty cool. We got a triple top right here. We have first retest, second retest. The highest high of the second retest equals the highest close of the first retest. And then we have a third retest that also does the same thing. The highest high of the third retest equals the highest close of the first test of this pattern. So not bad at all. We do have a triple top right here, and that is a reversal, a bearish pattern, if you will. But what I saw was, again, I don't take trades based off these reversal patterns because they're not always accurate. Although, of course, every time I'm showing you them, it makes it appear as though that they are almost always accurate. But trust me, I've tested these. They're not always accurate. Okay? They can be, but they're not always. There is a strategy that I was testing, which I might tell you guys about later. It's called the 26-18 trading strategy. It's a really good trading strategy that I could show you guys on. If you're interested in trading double bottoms, double tops, triple bottoms, triple tops, things of that nature, I can actually show you how you can take that trade, how you can trade them. But that'll be another video for another time. Right now, though, what I'm seeing is we came up here, we extended, we retraced down. I put my stop loss 10 pips below the low, entered here, and we're rallying. I don't know if this is going to rally all the way to and retest this high. It's looking like it has a good chance of doing that. So we're just going to have to wait and see. I know I say that all the time, but in the end, guys, it's the truth. Okay, it's the truth. I mean, look at this. Look at this. This is looking very similar to the pound dollar, right? Pound dollar, you know, we came down. And then we were we didn't come down as deep in the pound dollar as we did in the dollar Swiss that I just showed you and I'm about to dive deeper into. But we came down and then we reversed and we went higher. It's not out of the realm of possibility to do exactly what's happening in the dollar Swiss right now, where we're going to come higher and then we're going to totally end up reversing, because that's what happened here. I got short, right? We had a break below, close below the structure level. We violated structure level right here. Drew my fib retracement tool. Let's draw it in like we do every single time. Structure from that structure high to the structure low, swing high to swing low. We got the 618 fib retracement level right here. We shorted right here. Okay? And the market has been kind of just consolidating, made a new lower low, lower close. We made a new lower low with regards to this immediate structure. Obviously not with regards to the structure that it's inside of right now. But now we just made a new higher high, sending an opposite signal. Sending a signal this is going to continue higher when we were only a few pips away from my target. Now, a lot of you are probably going to be like, Matthew, man, you could have just taken your profits right there. You know, why didn't you take your profits early? Because I don't have it in my trading plan. And if you're telling me that, then I'm going to assume and give you the benefit of the doubt that you're new here, you're new to my channel, you haven't been watching me for a long time. But look, we don't do that here, okay? You shouldn't do that. If it's within your trading plan to do it, then fine. I got no problem with it as long as it's in your trading plan and you've back tested it. But if you haven't back tested it and it's not within your trading plan, then I'm going to say you shouldn't do it. You don't take profits early if your trading plan, your back tested trading plan doesn't tell you to do so. That's a great way to take smaller wins and bigger losses. And I know you could probably use my particular experience right here and say, well, Matthew, you're not exactly profitable. Just look at your equity curve over here. You know, oh yeah, you say all this, but look at that. That's just terrible. Look, this is an unback-tested strategy. I've said that many times. This is just me practicing my chart analysis. I thought it would be something fun to do to show you guys. And I mean, yeah, we're sitting at 1573 and we've got still a number of trades that are on. 9 trades that we're waiting for to come to fruition right now. And I have not backtested this over all of these currency pairs. So I don't know about the performance. I've been very open and honest about that. This is more just me practicing my analysis and me doing a trading journal to show you guys what keeping a trading journal is like. And also what it's like to trade a strategy that is unbacktested. You're taking shots in the dark. You really have no idea. Clearly, we're over trading, and we're losing money as a result of it. Yes, that is actually happening. But that said, though, you know, this is me just showing you what it's like to trade without a trading strategy to drive home the point that you need one. But it's also me showing you just me practicing my trading analysis and how to keep a trading journal, okay? And that's we'll talk about a bit more about that towards after this currency pair. But that being said, though, I decided to measure my fib retracement tool from this structure high right here. This is a minor structure high, so if it gets violated, that doesn't necessarily mean that this is an invalid shorting opportunity. This particular one is, but you may have another opportunity to short. You could just measure from the more major structure high right here to this structure low right here, swing high to swing low, and you could potentially look to get short here. Again, this is the conundrum that we face. There's also even a higher structure high that you could look towards. And this is ultimately the conundrum that we face. Do we continue to try and take shorting opportunities? If you decide to do that, at least, well, I'm not going to give you recommendations, but for me, I would only try twice. If I didn't get this one, I would measure for this one because that's the most major one that I can see that's closest. The next most major would be here. So I would measure from this one to see, and then assuming if I was going to take a second whack at it, I might decide to flip my analysis and see what happens. So, but that being said, you know, we came very close to the entry. I didn't take my profits. I won't ever take my profits. Even if I was watching these trades live, once I take them, I just sit on them until my target or my stop loss gets hit. I've got a target. I got a stop loss. Why do I need to watch them anymore? I don't want to organize my life to where I have to watch the markets all the time. Seriously, that's no better than having a job working for somebody else doing their work. I want to free up my time. That's why I'm trying to do this. That's why I'm doing this, is because I want to free up my time. I want the freedom of time, which is much more valuable than money. You know, we can always make more money. We can always find more money to make. You can always go get a part-time job. You can always make more money, right? You can always go get another job in a bad economy. Look, there's still opportunities. You can always make money. But you can't get your time back. So time is a non-renewable resource, and it's one of the only non-renewable resources that we have in our daily lives. You can't get it back, which is why it's so important to not surround your life around your trading plan. And again, look, guys, I've done a video on that before. All right, how to set up your life, plan your life. Or plan your trades around your life, not your life around your trades. That's kind of the whole mantra there. But, so we'll have to see. I was feeling pretty confident when we were heading in this direction. I'm not feeling confident about it anymore. Hopefully it just gets rejected and rolls over and we end up making money. Hypothetical dollars. But we'll just have to see. Have to wait and see. All right, guys. Well, hey, that is the end of this episode with regards to the analysis. It's for 42 minutes in. I'd like to end it there. All right, so that being said, guys, that's going to be it for this episode. Hey, If you are checking this out on YouTube, make sure to like the video and subscribe to the channel. Just make sure to hit that, pound that like button. And if you like the content, of course, you know, not only do that, but also consider sharing the content out there. You know, if you liked it, odds are there's going to be other people that you know that are going to like it. If you're in any kind of like trading community, if you really like this content, then please help me get the message out there. Help me grow this community of traders, and just, you know, just help me kind of get this out there. I would really appreciate that. Also, don't forget to check out my affiliate links. I always put them in the link in the bottom, in the description of every single video. Most of the time, it's Tier 1 Trading and TradingView. Guys, Tier 1 Trading, I mean, you guys have heard me say this a million times. It's like the #1 place to go to learn how to trade, in my most humble opinion. I love Tier 1 Trading. I love the mentors that are there. Those mentors are still mentoring me today. I absolutely love them. They will teach you the strategy and the arts of trading. They will teach you everything you need to know, not just a strategy, not just a lifestyle. They will teach you everything you need to know. So if you're interested to learn more and all the complex stuff out there, advanced pattern recognition, money management, go check them out, because they're definitely one of the best places to be. Also, if you're interested in a trading charting platform, check out TradingView, guys. TradingView.com, great place to go. It's not that expensive. It's only $19 a month. I think if you pay annually, it's like $19 a month. And guys, you get access to all this data, charts, chart alerts, all sorts of different kinds of stuff. You can even code automated trading systems into TradingView. So it's really cool to use and everything. I love it. It's the charting platform that I use for live data. For backtesting data, I actually use NinjaTrader 8, which I'll do another video of that later on. But all right, guys. Hey, hope you guys enjoyed the video. Like I said, if you did, make sure to like, subscribe to the channel, and also don't forget to share this content so that we can grow a community of traders and people who all want to become financially free and control their life and ultimately control their destiny. If you guys do that for me, I'll see you guys in the next episode. As always, know the risks, plan accordingly, and have a great day.